question with you? If yes, please confirm. If yes, please confirm. Okay, so what are we told? What are we told here? So the question is, as part of its staff motivation program, Beta Limited decided to grant each of its 600 employees 100 options to purchase the company shares effective from 1st April of 2016. The option were conditional upon one still being in employment as at 31st of March 2020. And then we are told the following additional details. The following additional details were provided with respect to the scheme. So we are given years, basically the years which ended 31st of March 2017, 2018, 2019, 2020. We are given the number of employees who are expected to terminate or to leave employment, and then the fair value of each option. Then from there, in the last paragraph, we are told the fair value of the option was shillings 25 on 1st of April 2016, and then you're told that the exercise price of the option will be shillings 12, and the par value of the company shares is shillings 6. So we are told the average market price of the share over the 4 years to 31st of March 2020 is expected to be 25. So what are we required to do? We're required to show how Beta Limited should report the transaction of the above scheme as per the requirement of IFRS 2, share-based payment over the 4 years which ended 31st of March 2020. And then we are told assume that all the eligible employees will exercise the right on 31st of March 2020. So basically, these are a question coming from that topic of the share-based payment transactions. And here we are given information about the employee share option. Remember, in this case, we said an employee share option. This basically whereby the employees of the company are basically given the privilege or basically the right to buy the shares of the company in the future, but upon fulfilling certain conditions, or the company can promise to pay a cash or even a bonus to the employees in future once the employees fulfill a certain condition. So we say that once you come across this particular question for employees share option, the first thing you need to identify is whether that employee share option is a cash settled, whether the employees will be paid a cash or basically a bonus in future, or whether the employees have been given a privilege or a right to buy the shares of the company in the future at a price below the market price. Now, if you go back to the information which are given in this question, specifically in the first paragraph, the first sentence, we are told, as part of its staff motivation program, Beta Limited decided to grant each of its 600 employees 100 option to purchase the company shares. So it automatically means that this employee share option is basically a share based. So the employees here will not be paid a bonus, will not be paid a cash in future, but rather they have been given a privilege to buy the company shares in the future. And therefore, even before you proceed to compute what is required, we say you can say that this is a share based, is not a share based, rather it is an equity settled, employees share option, share option. So if it is an equity settled, it basically means that the employees of this company have been given a privilege or basically a right to buy the shares of the company in future once they fulfill certain conditions. Now, still in that particular first point, that sentence number 2, we are told this share option was granted to the employees on 1st of April 2016. Now, 1st of April 2016, we refer to that particular date as the grant date. As the grant date, 1st of April of 2016, we refer to this as the grant date. Basically, it is the date when the employees were given this particular privilege or basically that particular right? And then you're told this option are conditional upon one still being in employment until 31st of March 2020. So 31st of March 2020. Now, this particular date here is the date the employees will be able to do to exercise this right. To exercise the right means that those employees will be working with the company on this date, and the ones who will be able to buy the shares of the company at a price below the market price. Now, what we said is that this basically privilege which is given to the employees to buy the shares of the company in the future at a price below the market price is basically a form of an employee's benefit. Is a benefit which is given to the employees. So the employees is a benefit, to the company basically is what? Is an expense. And therefore what we say is that because now the benefits will be given to the employees on this date, because that is the date they will be able to buy the shares, we say that those benefits given to the employees here relate to this particular period here, relate to this period from 1st of April 2016 to 31st of March 2020. That's why we said what we need to do is basically to determine the amount which will be recognized as an expense by the company here, by the employer, over the vesting period. Remember, this period we refer to it as what? The vesting period. And how many years do we have here? So in our case, the first year will end 31st of March 2017, the other one 31st of March 2018, the other one 31st of March 2019, and the other 31st of March 2020. How many years are those? 1, 2, 3, 4. So in our case, we have a period of, we have 4 years here. So what we need to do, we need to determine the amount to be expensed in year 1, in year 2, that is year 3, and also year 4. And actually we said, for us to be able to do that, for example, in year 1, to determine the amount which will be recognized here as an expense, we can only base that, we can only compute that based on the employees who are expected to be working with the company at the end of the 4th year. Remember, we said at the end of year 1, we cannot be able to tell the employees who will exit this company in year 2, year 3, year 4. We can only be able to use estimated what? Numbers. So for us to be able to compute the amount to be recognized as an expense, I gave you a certain formula here, which we said is very, very important, which will help you to compute the cumulative expense, to be the cumulative expense at the end of each year. So the cumulative expense at the end of each year, we said is computed based on this expected number of employees, or in other terms, you can just say employees expected to remain. In very simple terms, employees who are expected to remain, employees expected to do what? To remain. So employees are expected to remain are those employees who are expected to be working with the company at the end of the vesting period. How many employees will be working with the company at the end of the 4th year? And then we multiply this with the number of options, which are granted to each employee. Each employee has been given the right to buy how many shares? And then we said we multiply that with the fair value of each word, of each option. And actually, in this case, what we said, here, if now the employee share option is an equity settled, the employees have been given a privilege to buy the shares. So if an employee's share option is an equity settled, here we say that we use the fair value, of each option, at grant date. At grant what? Date. So if the employees have been given a privilege to buy what? Shares. But if it's a cash settled, the employees will be paid a bonus or basically a cash. We use the fair value of each option, at the end of each year, at the end of each year. Actually, we say that is very, 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 very important. And basically, we multiply this with what? With the proportion of what? Of time. So we say this formula, make sure you remember that. Particular formula. So I think having this now, we can be able to proceed and basically we answer our question. If you check on what you're required to do, we're required to show how Better Limited should report the transaction of the above scheme. To report basically is what will be recorded in the income statement, what will be recorded in the statement of financial position. So the first thing we need to do here is to compute the amount which will be recognized as an expense in each year. And then from there, we proceed, we prepare the financial statement extra. Now, for us to be able to compute the amount to be recognized as an expense, we have all this. We have the proportion of time. We have the fair value of each option at the at basically the grant date, we have this one, but basically we said one item which the examiner will not give you is this one. So the examiner will not give you the expected employees to do what? To remain. So that one has to be computed. That one has to be what? To be computed. So what I want us to do, I want us to compute the employees expected to do what? Expected to remain. Expected to remain. Number of employees who are expected to remain. Purchase is saying my Modimo's board is not clear. Is that the position? Is my board clear? Is my board clear? Is my video clear from your side? Okay. So purchase, check what is happening with the internet. Yes. Okay. So let's compute this. The number of employees who are expected to remain. How many employees will be working with the company at the end of the 4th year? So we start with year 1. Remember, year 1 ended on 31st of March 2016. So that is when the first year ended. So we will take the original number of employees who are there, which is given within paragraph 1, sentence 1. So the number of employees who are there are 600. And then we go to the information we have below paragraph 2, where we've given 4 years and also the number of employees who are expected to terminate or to leave. Now, as per year 1, we are told the employees who are expected to terminate or to leave will be 25. So in that case, we take 600 minus what? Minus 25. And basically, this will give us what? This will give us 575 what? Employees. 575 what? Employees. So we go to the to year 28. Basically, this should be 2017. Sorry. We go to the next year which ended 31st of March, July. That is okay. This should be March. This should be March of 2018. So in this case, we said we take the employees who remained here, or in other terms, we can take the original number of employees, 600, minus the employees who are expected to leave as by year 1, who are 25, minus, if we go to the year 2018, we are given 15 employees. So we say those 15 employees are the additional. Other than 25 employees who are expected to leave as by year 1, the company now expects additional 15 employees who do what? We leave. That's yes. And then we get the final figure here, which will be what? Which will be 560. Which will be 5 what? 60. So we move to year 3, which ended 31st of March 2019. So we take 600 employees minus the employees who are expected to leave as by year 1, minus additional employees expected to leave as by year 2, minus additional employees expected to leave as by year 3. And basically that will give us what? That will give us 550. And finally, the year which ended 31st of March 2020. So we take 600 minus 25, this one, minus 15, minus 10, minus the additional employees expected to leave as by year 4. And those are 10 what? 10 employees. So that now will give us what? That will give us 540. So having that now, we can be able to move and we compute the cumulative expense at the end of each year, and equally the amount of expense to be recognized in the income what? Statement. And actually, for us to be able to do that, we are going to use this particular formula here. So we need to have our computation here. We will have our 4 years. So the first year basically ended on 31st of March 2017. Year 2 ended on 31st of March 2018, 31st of March 2019, and 31st of March 2020. So then from there, we will have the other column here, which we said is for the cumulative expense. Cumulative expense. And finally, we have a column for the expense in the income statement. Expense in the income statement. The amount to be recognized as an expense in the income statement. So let's compute this. So remember, we are using this particular formula here. Yes, this is asking, are we supposed It is, remember what we said is here. In terms of how we compute this, it's all depend with the information which you are given. It all depends with the information which you are given. There is, I think, a different question which we did, whereby we were given the actual number of employees who left here, and then from there we were given the employees who are expected to leave in year, maybe in year 2, year 3, and maybe in year 4. So what do you do? We said in such a case, you take 600 minus the actual employees who left here, minus now the employees expected to leave in year 2, year 3, and year 4. So in terms of how you compute this, it all depends with the information which you are given. Sasa? Yes, and actually we say that this whereby the examiner will try to twist these particular questions. This is the area which is twisted by the examiner as far as the questions coming from this topic is what is concerned. So you need to do more questions on this so that you understand how do we compute this. Maybe we are going to look on such a question here. So having that now, let's move and compute this one. So we are using this formula here. This is the formula we are using. This is the formula we are using here. Yes, so first of all, we will take the number of employees who are expected to remain, basically for our 4 years. In the first year is 575. 575. So here is 560, 550, and basically 540. We then multiply that with what? We then multiply that with the number of options. So the number of options basically are the number of shares each employee was entitled to buy. So that information, we have it in paragraph 1, sentence 2. We are told Beta Limited decided to grant each of its 600 employees 100 share option, 100 share option. So those are the number of options granted to each employee, And then from there, we multiply that with the fair value of each option. Which fair value do we use here? Take into account it is an equity settled. So if it is an equity settled, we use the fair value of each option at the grant date, not at the end of each year, at the grant date. And that information, we have it in the last paragraph. In the last paragraph, we are told the fair value of option was 25 on 1st of April 2016. 1st of April 2016, remember, is the grant date. So we use the fair value of each option at the grant date. And basically that is 25. 25, 25, 25, 25. But remember, in this case, we said that if, for example, this one was what? This one was a cash settled. The employees were to be paid a bonus or basically a cash at the end of the vesting period. Then we use the fair value of each option at the reporting date. And the fair value of each option at the reporting date, we say, is equivalent to the market price of each share at the end of each year. Basically what we have below paragraph 2. Sasa? Yes, and finally we multiply this with the proportion of time. The proportion of time here will be 1. How many years do we have in total? Here we have 4 years. So the proportion of time will be 1 over 4. Here will be 2 over 4. Here will be 3 over 4. Here will be 4 over 4. 4 out of 4. Sasa? Yes. So let's compute the cumulative expense in year 1. In year one, I'm given what here by Gilbert, 359, 375. Can you confirm whether that is what you're getting in year 1? Are you getting that value? 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 359, 375. Yes. So then we say that this is basically the same amount to be expensed in year 1. The same amount to be treated as an expense in year 1. Then we move to year 2. Year 2, we take 560 times 100. Times what? Times 100. Times 100. Janet, I think I've explained why I'm using 25. Have I not explained, Janet? I've explained, I've said that this is an equity settled. So if it is an equity settled, I think I've given those notes here. If it's an equity settled, you use the fair value of each option at the grant date from year 1 to year 4. But if it is a cash settled, the employees have been promised to be paid a bonus or a cash, we use the values under paragraph 2. Use the values under paragraph 2. In fact, that's what I mentioned even before we started our computation here. Once you come across these questions for employee share option, you need to identify, are the employees buying shares? They've been given the right to buy shares? If they have been given the right to buy shares, is an equity settled? So when computing now the amount to be expensed, use the fair value of each option at the grant date from year 1 up to the last year. But if the employees will be paid a cash or a bonus, it is a cash settled. Use the fair value of each option at the end of each year. If, for example, the employees here were to be paid a cash, then we would have used the fair values in note number below paragraph 2, 20, 16, 16, and 12. Sasa? Yes. Okay, so this now here will give us, I think, 700. Are you getting 700 here? 700? 700, yes. Then the amount to be recognized as an expense here will be the difference between these two values here. The difference between cumulative expense in year 1 and year 2. Year 1 and year 2. So that will give us what? That will give us 340, 625, 625. So what about cumulative expense in year 3? Cumulative expense in year 3? You're getting what? 1031 to 50. Yes, so the amount to be recognized as an expense here will be the difference between those two values. So which is 331, 250. And basically the last year, what do we get here? We have 540 times 100 times 25, which will give us 1,350,000. So the amount to be recognized as an expense here will be the difference between these two values there. Which is 318, 750. So that is the amount to be recognized as an expense in year 3, or actually in year 4, not year 3. So basically what you require to do here, we require to show how this company was supposed to account for the transaction. Was supposed to, is it to account or to report? Not to account, to report. To report means we need to prepare financial statement extract. We need to prepare financial statement extract. And basically we show what was supposed to be recognized in the income statement and equally what was supposed to be recognized in what? The statement of financial position. So let's start with the income statement extract. And actually we said here, we just need to remember that this is the amount to be, which was supposed to be recognized by our company as an expense in the income statement over the period of 4 years. So we need to have our 4 years here, 31st of March 2017, 31st of March 2017, 2018, 2019, and 2020. So this amount was supposed to be recognized as an expense. So at the expenses, our company was supposed to recognize something called the employees. What we said, you can just refer to that as employees remuneration. Employees remuneration. This is basically a benefit the employees are entitled to. So the first one, or the first year was 359, 375. Year 2, 340, 625. Year 3 is 331, 250. And then year 4 is 318, 750. So this is what our company was supposed to recognize here as what? As an expense. As an expense. As an expense. And finally, we prepare the statement of financial position. Statement of financial position extract. Statement of financial position extract. So in the statement of financial position extract, basically we need to show what was supposed to be recognized here over a period of 4 years. The first year ended 31st of March 2017, 31st of March 2018, 31st of March 2019, and 31st of March 2020. So we said here, what the company was supposed to recognize here is basically this amount here, these cumulative figures, of which we say, by the company basically accounting for this as an expense, the company is setting aside money from its profit to pay for those particular shares which will be issued to the employees at the end of the 4th year. So therefore, we say that this cumulative amount should be recognized here as what? Should be recognized here as a reserve, as a reserve. So being a reserve, it should be recognized as a component of equity. And actually, we say you can just refer to that as employees. Employees what? Employees share option reserve. Or you can just come here and you refer to that as simply as what? As an equity. As what? As an equity. So the balance or the total or the amount to be recognized in year 1 here will be 359, 375. Year 2, not this one, but the cumulative amount. The cumulative amount of 700,000. Year 3, we have 1031, 250. And year 4, we have 1350,000. So this is what the company was supposed to recognize in the statement of financial position. Basically, as what? As what? As a component of equity. Now, there is something we also need to. Do we need to note that here? We need to note that there. I think no, because in our case, we are required to do what? Just to show how the company was supposed to report this, basically to account for this, Yes, so that is it, that what was required there. I don't know whether you can get another question which is tested differently. Because we say this particular question, they keep on twisting them, especially when it comes to computation of this. The number of employees were expected to remain. That is the area whereby the examiner will try to catch you. The examiner will try to catch you. The examiner will try to catch you. Yes, I think in class we're able to do, I think, a number of questions. I think maybe you can try and see whether you have a different question here. So it will not get basically we move to the other topic. Mike is asking about what? The time basis. Time basis. I think we said here, you just need to, this is not time basis, but basically the proportion of time. Proportion of time. How many years do we have here? We have 4 years. We have 4 years. So whatever you compute here in year 1, whatever you get here, this is the amount to be recognized in the next 4 years. But now, as per year 1, you want to know the amount to be recognized in year 1 out of 4 years. So first of all, know how many years do we have? If you check on the other questions we did in class, I think most of them we had 3 years. So the proportion of time here, for example, was 1 all over 3, 2 all over 3, and 3 all over 3. But in this case, we have 4 years. We have 4 years. Yes, I think maybe you can just yes. So there is a question which I'm trying to look for here, and I think I've seen it. I don't know whether we did that question in class. Did we handle this question in class for November 2018? November 2018. Okay, sawa. So let's do this one as the last one. We try to hurry up so that we look on something else. November 2018 1C. November 2018 1C. November 2018. Question 1C. Yes, I hope you're there. I hope you have the question with you. Yes, are you there? Are you there? Okay, so what are we told here? We are told on 1st January 2015, G Limited granted each of its 200 employees a 500 share option. This share option were to vest if the employees still worked for the entity as at 31st of December 2017, and if the share prices on the date exceeded 45. So in that case, you can see we have two conditions which are set by the employer that for an employee to be entitled to this privilege, so an employee must work with the company for the next, or actually up to 31st of December 2017, and basically the share price on that date exceeded 45. The market price per share on 31st of December 2017 would be more than 45. So in this case, what we consider is whether one condition, just one condition has been fulfilled. So mean that those employees will be there at the end of 2017, will be entitled to buy the shares, even if the market price per share will be less than 45. So provided one condition is fulfilled out of the two. And then you are told that on the grant date, the fair value of each option was 15. And then you're told the share price on 31st of December 2015 was 27. And it was considered unlikely that the share price would rise above 45 by 31st of December 2017. It basically means that one of the conditions set by the employer there in paragraph 1 will not be fulfilled. So the share price at the end of 2017 would be less than 45. So then we are told 20 employees left the company during the year, which ended 31st of December 2015. And a further 20 employees are expected to leave in the next 2 years to 31st of December 2016 and 31st December 2017. So then you're told during the year which ended 31st of December 2016 and 31st of December 2017, 15 employees and 25 employees left the company, respectively. So what are we required to do? We are required to prepare extract from the financial statements of G Limited for the year which ended 31st of December 2015, 2016, 2017, 2018. How many marks were allocated there? 6. And I think this is a very good question in relation to what Reese was asking. So what if you're given the actual employees who left? So because if you check on the information which you're given in the other question, it was totally different from this. But basically what you have said is that even before you proceed to answer what the examiner requires here, can you first of all identify whether this is an equity settled or a cash settled employee share option? Will the employees be paid a bonus? Will the employees or have the employees been granted the option to buy the shares at a price below the market price? So if you check on the information we have within paragraph 1, the employees were granted 500 share option. So if they have been granted 500 share option, they have been granted the right to buy the shares. So if that is the case, then this is what? This is an equity settled. This is an equity settled employee share what? Employees share option. employee share what? Option. So if it is an equity settled, we have said when computing now the amount to be expensed, when computing the expense to be recognized in the income statement, then we use the fair value of each option at which date? At the grant date. At the grant what date? That's why it is important for you to determine whether it is an equity settled or a cash settled. If it was a cash settled, whereby the employees have been promised to be paid a bonus or a cash, we use the fair value of each option at the end of each year. At the end of each what? Year. Now, having that, and then from there we can have our general formula. How do we compute the cumulative expense? Because I've said this is a formula to guide you. So we take the employees who are expected to remain. Employees expected to remain. How many employees will be working in the company at the end of the vesting period? You multiply that with the number of options granted to each employee times the fair value of each option, in which case here we have said, because these are an equity settled, we are going to use the fair value of each option at the grant date. And finally, we multiply that with the proportion of what? Of time. The proportion of time. Basically, in our case, we have said all these items are given. The proportion of time, the fair value, the number of options, which the examiner will not give you is that. And this, where the examiner tried to twist these particular questions. If you check these particular questions for share-based, this is the area whereby the examiner tried to catch you by twisting the information. So I want us to compute this. Number of employees who are expected to do what? Who are expected to remain. The number of employees who are expected to remain. And I hope you have noted that here we have how many years? I think we have a vesting period of 3 years. Basically, you can get that from the requirement. We are required to prepare extract of financial statement for 2015, 2016, 2017. So we have 3 years vesting period. So we will start by computing the number of employees who are expected to remain as at the end of 2015. That is the end of the first year, 31st of December 2015. How do we compute this one? We take the original number of the employees. In the first paragraph, the employees who were originally there were 200. And then now, where are we given information about the employees who are expected to remain? Or basically not to remain, rather to leave. That information, we have it within from paragraph 3. Can we go to paragraph 3? In paragraph 3, we are told 20 employees left the company during the year which ended 31st of December 2015, and 20 further employees are expected to leave in each of the 2 years, the year which ended 31st of December 2016 and 2017. So remember here we have 3 years, 2015, 2016, 2017. So we are told in the first year here, that is basically year 1, we are told that the employees who left here were 20. Well, how many employees were 20? So automatically, it is important for you to note that at the end of 2015, the company we can't tell with certainty how many employees we leave in year 2 and also year 3. So in year 2, year 3, we can also only work with estimated figures. So for us to be able to determine the employees who are expected to remain as per year 1, we will deduct the employees who left in year 1, who are 20. And then in that case, we are told a further 20 employees are expected to leave in each of the 2 years. So in 2016, 2017, the company expects 20 employees will leave in each of those 2 years. So therefore, the employees who are expected to be working in the company here will be 200 minus the one who left in year 1, minus the one who are expected to leave in year 2, minus the one who are expected to leave in year 3. Sasa? Yes, and basically this will give us what? This will give us 140 employees. 140 employees. Is that clear? Is that clear? I think this is a question which was is it this was asking about this one? I hope that one is now clear. Can you understand now what you're doing here? Can you see there is a difference between this question and the other one which you have done? Yes. So let's move to year 2. The year which ended 31st of December 2016. So now, at the end of 2016, we know the employees who left here. We know the employees who left in year 1, they were 20. So automatically in year 2, we also know the employees who left here. So that information, we have it in the second sentence. Actually, in the last sentence, we are told during the year which ended 31st of December 2016, and 31st December 2017, 15. So the actual employees who left here were 15, and here were 25, left the company respectively. So now at the end of 2016, we know the employees who left here were 20. The employees who left in year 2 were 16. That is, in the year 2016 were 15. Sorry, were 15. In this case, at the end of 2016, do we know the actual employees who will leave the company in year 3? At the end of 2016, do we know the actual employees who will leave the company in the year 2017? Automatically no. Automatically no. What that means, here we can only work with the estimated figure. How many employees do we expect will leave the company in 2017? How many employees are expected to leave the company in year 2017? The employees expected to leave the company will remain as 20. As what? As 20. So I hope you can see what you're doing here. We have taken the original employees minus the employees who left in year 1. We know that is 20, minus the employees who left in year 2. We know they were 15. But at the end of 2016, we can't tell the actual employees to leave in year 2017. So this will give us what? This will give us 145. And then now, in the last year, that is 2017, we don't compute the actual employees to remain, but in the last year, we compute the number of employees who actually remained. So these are the actual employees who remained. Because at the end of 2017, we know 20 employees left, 15 employees left in year 2, and 25 employees left. So here we compute the actual employees to do what? The actual employees who remained. So this one, remember this at the end of 2017, this will be 200 minus the employees who left here 120, minus the employees who left here 2, minus the employees who left here 3. So those are the actual figures. Those are the actual figures. That will give us what? This will give us 140 what? 140 employees. 140 employees. So you can see this question is basically different from the other one. So I think now we can move and we basically compute the cumulative expense and the amount of expense to be recognized in the income statement. Cumulative expense and also the expense in what? In the income statement for the period of 3 years, for the period of 3 years. So this one is quite simple now. So our 3 years, the first year ended on 31st of December 2015, 31st of December 2016, 31st of December 2017. So we are using this formula here. Number of employees were expected to remain as per year 1, 140, year 2, 145, year 3, 140. So we multiply that with the options granted to each employee. The options granted to each employee, that information we have it within paragraph 1. Within paragraph 1, so each employee is granted 500 share option. 500, that will not change. And then we multiply that with the fair value of each option, the fair value of each option, Take into account the employees have been given a privilege to buy shares is an equity settled, is an equity settled. We need to use the fair value of each option at the grant date. The fair value of each option at the grant date. Where do we have that information? We have it within paragraph 2. On the grant date, the fair value of each option was 15. So that will not change. That will not change. Times the proportion of time. The proportion of time here will be 1/3. We have 3 years. Here will be 2/3. Here will be 3 out of 3. 3 out of 3. Then we get the cumulative expense. The cumulative expense. The cumulative expense in year 1. Cumulative expense in year 1. What are you getting here? So here we have what? We have 350. That should be the same amount to be expensed, to be treated, to be recognized as an expense in the income statement. Year 2, we have 145 times 500 times 15 times 2 divided by 3. 7 what? 25. I hope those are the figures you're getting. So how do we get the amount to be recognized as an expense in year 2? We get the difference between the cumulative expense for 2 years. The difference is what? Is 375,000. And then finally, the cumulative expense for year 3, 140 times 500 times 15. And basically that will give us what? Yes. And I'm only getting answers from Gilbert. I'm getting answers from Gilbert. Are you getting those figures? Please confirm. Are you getting those figures? 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 Yes. So then we get the cumulative expense here, which should be the difference between these two. And that is what? 325,000. 325,000. Yes. So we are done with that. Then finally, we can prepare the extract, financial statement extract. Financial statement extract. We start with the income statement or the statement of profit or loss. Statement of profit or loss. So we will prepare this for 3 years. The year which ended 31st of December of 2015, 31st of December 2016, 31st of December 2017. And we have said that this amount will be recognized as an expense here. As an expense. So, and the name of the expense will be employees remuneration, or basically employees benefits. Employees remuneration or employees what? Benefits. Remember, what is marked is not this one. What is marked are the figures. These are the figures which are marked. Yes, so the person who is marking your paper will basically be checking for these figures, not the description. 375 and 325. 325. What about the statement of financial position extract? Statement of financial position extract. So we have said whatever you have here, the cumulative amount will basically be recognized here as a component of equity. As a component of equity. As a component of equity. 31st of December 2015, 31st of December 2016, 31st of December 2017. Yes. So at the equity, we will have something called the employees share option reserve. Alternatively, I've said you can just refer to that as equity. If you can't remember that name, just come here and we say in the statement of financial position, the company will recognize equity, which is equivalent to the cumulative amount. The cumulative amount in year 1, 350,000. Year 2, 725,000. Year 3 is what? Is 50,000. 50,000. So that is basically what was required there. The what? The financial statements extract. The financial statements extract. Yes. So that is it. That basically what was required as far as that question is concerned. A question on what? On the share base. So what you need to do, try to look on those two questions we have done, and also the other questions which we did in class. I think if you revise on those topics, so automatically once you come across a question from this, you should be able to comfortably handle that particular question. I want us to just take a short break, and then I want us to come back. We look on a question on deferred tax. There is a question I want us to do here. Let me get the question so that as we come back, you'll be having that question on deferred tax. You'll be having that question on deferred tax. Yes, so I think like there are two questions. I don't know whether time will allow us to be able to do those two questions, but I think we can only do one. Let's just do one. A question on deferred tax. Steve, the past papers are in the class WhatsApp group, but I think someone should reshare them. Yes, can someone reshare those past papers? Reshare those past papers in the class WhatsApp group. Someone to reshare those papers in the class WhatsApp group. So there is a question which is here. I don't know whether we did it in class. Maybe someone to confirm for me. The question for September 2021 on deferred tax. Did we handle that question in class? September 2021. The question on deferred tax. Okay. So I'm told, yes, so maybe you can get that one. This one, September 2021, question 3. Question 3. So ensure you have those that question. We take a short break, just a short break, and then we come back at 5:20. 5:20, we look on this question. It's basically a question on deferred tax. So let's just take that short break. We come back exactly at 5:20. Yes, we continue. I hope you have the question with you. We go straight to part A of the question number 1. And the question reads, with reference to deferred tax, differentiate between permanent difference and the temporary difference. Differentiate those two terms. So part A, Roman 1, we are required to differentiate between the permanent difference and the temporary difference. The temporary difference. So this is something we discussed in the topic of this topic of deferred tax. And anytime you're required to differentiate, you differentiate by defining what is permanent difference, what is temporary difference. That's how you differentiate. So first of all, we said the temporary difference. Maybe you can just start with the temporary difference. Temporary difference, we said that this is the difference between the carrying amount and the tax base of an asset or liability. So temporary difference is the difference between tax base, the tax base that is TB, and carrying amount carrying amount. So carrying amount abbreviated as CA, or asset or liability. Of asset or liability. And I hope also you can be able to recall, we have two types of temporary difference. We have the taxable temporary difference, and we have the deductible temporary difference. So what do we mean by the permanent difference? So permanent difference, we say that this is the difference between the accounting profit and taxable profit, which arises as a result of taking into account certain items of incomes or expenses only in the computation of accounting profit. So this difference is basically occasioned by items such as depreciation. When computing the accounting profit, depreciation is treated as an expense. But when in taxation, in computing the taxable profit, do we use depreciation as an expense? No. Depreciation is disallowable expense. So therefore, there is a difference between accounting profit and taxable profit, which arises as a result of taking certain items of incomes or expenses only in the computation of accounting profit. So is the difference between accounting profit, and remember in this case we said accounting profit is the profit before what? Tax. Accounting profit or the profit before tax, and the taxable profit, as a result of taking into account certain items of incomes and expenses in computation of accounting profit only. In computation of accounting profit only, e.g. depreciation, e.g. the fines, etc. So we said these are items of expenses, but they are only used in the computation of taxable profit, in the computation of accounting profit. We don't use those items in the computation of what? In computation of taxable profit. So that's basically how you differentiate that. Let's move to the other part of that question, that is Roman 2. Roman 2 of the question. So what are we told in Roman 2? Roman 2, we are told Huruma Limited is a public limited company. That is, Huruma Limited, a public limited company, has a portfolio of investment. Portfolio is a mixture of investment, including various subsidiaries, and also undertake various projects varying from debt financing to investing in property and commodities. The following information was extracted from the group financial statement relating to the deferred tax. Relating to the deferred tax provision for the year which ended 31st of March 2021. So that we have that information from note number 1 all the way to note number 6. What are we required to do here? We are required to compute or to determine the deferred tax asset or liability for Huruma Group as at 31st of March 2021 in conformity with IAS 12. Now, if you check on the information which are given in note number 1, note number 2, note number 3, note number 4, 5, basically we're given various items of assets and liabilities. And I think what we need to do is to compute the temporary difference in respect to each of those particular what items. For example, in note number 1, you are told Huruma Limited, which is basically the parent company, acquired a controlling interest in a subsidiary, Shukari Limited, on 1st of July 2020. The fair value of the net assets, the assets and liabilities acquired were considered to be equal to the carrying amount, with an exception of a freehold property whose fair value was 256 million and tax base of 248. So in other terms, what we need to do for us to be able to compute whether there was a deferred tax asset or a deferred tax liability at the end of the year, we must compute the net amount of temporary difference And that is what we are going to use. Now, for us to compute the temporary differences, which you have said is the difference between carrying amount and the tax base of assets and liabilities, we must prepare the schedule of the temporary difference. So let's prepare the schedule of temporary difference. The schedule of temporary difference or temporary differences. So how do we prepare this schedule? We need to have basically a number of columns. So the first column here will be for the various items of assets, stroke liabilities, various items of assets and liabilities. The next column here will be forward. The next column here will be what? Forward for the carrying amount. I hope you can remember how we were preparing this. The next column will be for the tax base. So this is carrying amount, the CA, and tax base, that is TB. And then we have what? We have the last column here, which will be the temporary difference, that is the TD. And then if you check on the figures which are given here, all our figures are in million of shillings. So equally, our figures here will be in million of shillings, will be in million of shillings, in million of shillings like that, in million of shillings. So I want us to proceed and basically we compute these temporary differences. We compute these temporary differences. So let's do that. So we go straight to point number 1. In point number 1, what are we told? We are told Huruma Limited. Remember, this is now the parent company. So remember what we said, that most of these particular questions will come across for deferred tax at this level. We say they have the aspect of group account, So we are told Huruma Limited acquired a controlling interest in a subsidiary, Shukari Limited, on 1st July 2020. And then we are told the fair value of assets and liabilities acquired were considered to be equal to their carrying amount, while with an exception of freehold property with a fair value of 256 and tax base of 248. Huruma Limited, or the directors of Huruma Limited have no intention of selling the property. So in that point number 1, we are given a freehold property. Basically, what we need to do is to identify these two values, the carrying amount and the tax base. But I hope you can be able to see we are given the tax base, which is 248 million. So what is the carrying amount? Remember, once the parent company acquires a subsidiary, this subsidiary revalue the assets, revalue the assets. Now, when we are preparing the consolidated statement of financial position, we should take into account the asset of this subsidiary at the revalued amount. So that subsidiary which was acquired, that is Shukari, we are told it revalued this property at an amount of 256. So that property, freehold property, will be recorded in the consolidated statement of financial position at an amount of what? 256, the fair value, value. Then we get the difference here, this minus this, and that will give us what? 8. Is it 8? We try to hurry up because of time. I can see our time is moving very fast. Is that giving us 8? 8. And because it's positive, we say it is taxable temporary difference. We said once you get a positive figure, it's taxable temporary difference. If you get a negative figure, is the deductible temporary difference. Let's move to point number 2. And we are told during the year which ended 31st of March 2020, that is 31st of March 2021, Huruma Limited sold goods at a price of 48 million to another subsidiary, 𝐉𝐻𝐶 Limited, and made a profit of 16 million on the transaction. And then you're told 40% of these goods were held in the inventories of 𝐉𝐻𝐶 as at 31st of March 2021. Remember, there is still another question which we did in class, which we were given similar transaction. And basically what we said is that we are told the parent company sold some goods now to the subsidiary, and some of the goods remained unsold. remain unsold, basically what we consider here for the purpose of computing the deferred tax are the unsold goods. Because the unsold goods, these were part of the inventory. These were part of what? Of the inventory. So what we consider here are those sold goods which were part of the inventory. We need to determine the carrying amount. We need to determine the what? The tax base. So can we first of all compute the value of those particular goods not yet sold at the end of the year? The value of those goods which were not yet sold at the end of the year. So we are told that the parent sold goods with a selling price or a selling price of 48. So the parent company sold goods to the subsidiary at an amount of 48. And we are told and made a profit. The profit which was made by this company here is what? Is 16 million. That is the profit which was made, 16 million. And then you're told 40% of these goods were held in the inventory of 𝐉𝐻𝐂𝐔𝐒 at the end of the year. So what we need to do is we compute the unsold goods. Unsold goods. So unsold goods, we are told are 40%. 40% of what? 40% of this. 40% of the sales. 40% of the sales. 40% of the sales, which is 48. This will give us what? The unsold goods. 40%. Yes, this one will give us 19.2 million. Now, remember, we say that this one is basically what? This one, if you can be able to recall the question which we did, we say that this is the cost, or actually, yes, is it the cost? Yes, it is actually the cost of the goods now to the buying company. But we say when these goods, or when preparing the consolidated statement of financial position, we take this particular unsold inventory or unsold goods, and then we less something called the unrealized profit. The unrealized what? Profit. So in other terms, the carrying amount will be equal to the unsold goods, but we less the unrealized profit. That's basically what we know from the topic of group accounts. If the parent company sells some goods to the subsidiary, and some of the goods remain unsold, the unsold goods will be reflected in the balance, will be part of the closing inventory of the subsidiary. But now, when preparing the consolidated statement of financial position, we take the inventory of the parent plus that of the subsidiary, and then we less the unrealized profit. Now, in this case, can we be able to compute the amount of unrealized profit? Because we know the parent company made a profit of 16 million, and then we are told 40% of the goods were not yet sold. Can we say the unrealized profit was equivalent to the unsold goods? Can we say the unrealized profit will be 40% of the profit which was made? Yes, that will be very much correct. So the unrealized profit here will be equal to 40% of the profit which was made by the parent. That's that. Yes. The parent company makes a profit of 16 million, and because 40% of the goods were not yet sold, the unrealized profit will equally be 40% of the profit. Of what? The profit. And this now how we compute the carrying amount. 19.2 minus the unrealized profit. Minus the unrealized profit, which will give us 12.8. 12.8 is the carrying amount, but the tax base is this. 19.2. 19.2. So what is the difference here? What is the difference? Is it 6.4? No, it is not 6.4. This minus this. Yes, negative 6.4. And that is deductible temporary difference. Yes, so if you compare this with the other question which we did in class, you'll be able to see we are doing the same thing. So let's move to point number 3, and we are told Huruma Limited has a portfolio of financial assets comprising of readily marketable government securities, which are held as current assets for trading purpose. And then you're told these investments are stated at the fair value in the statement of financial position with any gain or loss taken to the profit or loss. So we are told the gain or losses are taxed when the investment are sold. Currently, the investment have a market value of 412 million and accumulated unrealized gain of 64. So basically, what you're given here, number 3, are financial assets. And I hope you can see we are told these financial assets, they are held within the current asset. If they are held within the current asset, automatically these are short-term investment. These are short-term investment in shares. Now, such short-term investment in shares, if you can be able to recall from what we did in the topic of financial instrument, we refer to such investment as financial asset at fair value through profit and loss. This is basically investment in shares purely for speculation. So a company has invested in shares, hoping that the market price will increase and the company do what? Sell those shares, get a gain. Now, there is a question still we did, and basically I say that as far as this financial asset is concerned, the carrying amount is always equal to the fair value. That is something I said. What about their tax base? Their tax base is always equal to the costs. That is basically what you need to remember as far as the financial assets are concerned. And I think you can see in the last sentence, we are told that currently investment have a market value of 412. Market value is the same with the fair value. So the carrying amount will be equal to the fair value or the market value, which is 412. What about the tax base? The tax base will be equal to the cost. And remember, in our case, we are told that these financial assets, they have accumulated gains over 64. So it basically means that from the date they were acquired, they have their value has increased with 64 million. So if they were acquired, for example, at 300, and we are told there is accumulated gain of 64, their value has increased with what? With 64. With 64. Can we be able, therefore, to get the cost? Can we be able to get the cost? Yes, we can be able to get the cost. The cost will be equal to the current market value, which is 412, minus the increase in the fair value. The increase in the fair value is the revaluation gain. So once we less this the current market price, or actually we less the gain from this current market price, that will give us the cost. That will give us the cost. They were acquired at a cost of what? They were acquired at a cost of 348. 348. So as far as the financial assets are concerned, just remember this. Carrying amount, fair value or market price, tax-based cost. So we get the difference, which will be 64, and that is taxable temporary difference. So we move to point number 4, and we are told, point number 4, we are told, 𝐻𝐶 Limited loan asset has a carrying amount of 168 million after an allowance for credit losses. Credit losses, basically nowadays we don't talk of bad debt written off. We talk of credit losses. If you have a business, your customers have failed to pay, we don't talk of bad debt nowadays. We talk of credit losses. That is a credit loss. You give losses, you give credit to your customers, but because they have failed to pay, you have incurred a loss. You have incurred a loss. So that is called a credit loss. But now, if equally you expect that some of your debtors will not pay the amount they owe you, you create a provision for credit losses. Currently, we don't talk of the allowance for doubtful debts. We talk of allowance for credit losses. So we are told 𝐻𝐶 Limited loan asset. Loan asset is basically whereby the company has given loans. So if you have given loan to your customers, that is a loan asset. You expect your customers to pay you back. You recognize that in your books of account, in your financial statement as a loan what? Asset. So we are told this company has a loan asset with a carrying amount of 168 after making allowance for credit losses of 32 million based on 12 months expected credit loss. And then you're told the tax relief is only available when the specific loan is written off. That one is also very simple. In fact, this is basically similar to receivables. Receivables. So here we have loan asset. Loan asset. Loan asset. These are the loans given to the customers of this company. Once the company has given a loan, this is something you also need to remember from what we did in the topic of financial statements of a bank. Once the bank has given loan to customers, to the bank, that is an asset. To the bank, that is what? Is an asset. So We are given the carrying amount. Carrying amount, no problem with that, 168. But we are told this figure is arrived after the company had created a provision or allowance for credit losses of 132. So now the concept which we use here to determine the tax base is the concept we were using in receivables. In receivables, remember, this is equivalent to receivables. These are loans given to customers, just like where the business will sell some goods to the customers on credit. If you can be able to recall what I said in relation to the receivables, I said carrying amount is always equal to the net. For example, in our case, this one is the net. What about the tax base? Tax base, I said, is equal to the gross. So how do we get the gross? The gross is quite simple. We will take 168. We add back the amount which has already been deducted of 32. So that will give us the gross amount of the loan asset. The gross amount of the loan what? Asset, which will be 200. This minus that, which will give us negative 32, deductible temporary difference. Deductible temporary difference. Deductible temporary difference. So the concept we have used here is equivalent to the concept we were using for receivables. And then number 5, we are told Huruma Limited has an relieved trading losses of 20 million as at 31st of March 2021. These unused tax losses arose from one of restructuring exercise carried out during the financial year, and it is highly expected that taxable profit will be available in the future. So basically here we have something called the unused tax what? Losses. Unused tax losses. So what do you mean by unused tax losses? This is something basically, for you to be able to understand this, we have to borrow the knowledge you covered in tax. Now, let me ask, if, for example, a company make a loss, assuming we have 2024, during this year, the company make a loss of like 20 million. What basically happens to this loss in taxation? Who can tell us? This loss, when it comes to the year 2025, assuming in the year 2025, the company make a profit, how do we treat this loss now in the year 2025? Who can tell us? When it comes to the computation of tax in the year 2025, how do we deal with this particular loss, which was reported in 2024? Reduce the loss, or yes, basically this loss we carried forward and basically we deducted from the profit for the next year before we compute the tax. Before we compute what? The tax. That's basically the concept you covered in what? In taxation. Now, in our case, having that knowledge, we need to ask ourselves two things here. Now, these unused tax losses, will it be taken to the income statement? Will it be recognized in the income statement as either an asset or liability? Do we recognize it in the income statement as an asset or liability? These unused tax losses, do we recognize it as an asset or liability? Because if yes, we will be able to determine its carrying amount. Do we recognize it in the income statement as an asset or liability? Yes or no? Yes or no? Do we recognize it as an asset or liability? In the not in the income statement, in the balance sheet, in the statement of financial position. Do we recognize it there as an asset or liability? No. The tax asset, remember we have a difference between tax asset. Tax asset is what? A tax asset is basically a tax refund you are expecting from the government. But these are losses. These are losses. So if you report losses, that is not recognized as an asset or liability. In fact, it only affects a component of equity. So this one, we don't recognize it in the statement of financial position as either asset or what? Liability. It is not an asset or liability. What that means is that The carrying amount for that item, is what? Is 0. Is what? Is 0. Are we together? But now, when computing, for example, the taxable profit of this year, we are saying this loss, which was reported during this year, will be taken into account and deducted from the profit for this year. So tax base is the amount which will be deducted from the profit of the next financial year. So, and the tax base in our case is the losses which were reported. The losses which were reported in our case is 20. Now, this one will have to be carried forward and it will be deducted from the profit of the following financial year in case the company reports what? A profit. So therefore, the amount which will be taken into account in computation of tax for the following financial year will be 20. So carrying amount 0, because this one will not be recognized as an asset or liability, but it will be carried forward. It will have to be offset against future profits. And this such an amount should be carried forward for a maximum of how many years? If you report a loss in your company, you should carry forward that loss for how many years? A maximum of 5 years. A maximum of 5 years. So therefore, we get the difference, this minus this, which will give us negative 20, which is basically deductible temporary difference. Yes. So finally, I think in number 6, we are given the deferred tax at the start. So we are done. We are basically done. We are done. So what we need to do is we get the net amount down here. Can you give me the net amount? Net amount. Net amount. Net amount. We have 8 minus 6.4 plus 64 minus 32 minus 20. Okay. Yes, so here I'm given 13.6, which is basically a net taxable temporary difference. A net taxable temporary difference. So having this, what we are required to do is we are required to compute the amount of deferred tax asset or liability for this company at the end of the year. So we need to compute. Remember, we said a taxable temporary difference. This will give rise to something called a deferred. Sorry, it will give rise to something called a deferred tax liability. So therefore, in our case, we need to compute the deferred tax liability. We need to compute the deferred tax liability at the end of the year. That is the year which ended 31st of March 2021. How do we compute this one? We take the net taxable temporary difference. Net taxable temporary difference, what we have computed here, we multiply this with the tax rate. We multiply that with the tax rate. So 13.6 million. Are we given the tax rate? If the tax rate, yes, tax rate is in note number 6, which is 30%. Which is 30%. That will give us what? That will give us what? That will give us 4.08 million. Is that what you're getting? 4.08 million, which is basically a deferred tax what? Liability. A deferred tax liability. Yes. So that basically what was required as far as that question is concerned. Automatically, there'll be some marks for this. And the marks may be for the final answer there. Yes. So that is it. That what was required as far as that question is concerned. And basically that is it on that question. So I think for today we stop at that point. So what do we revise once we meet in the next class? I think we have not managed to revise on financial instrument. Financial instrument, maybe I'll get a question on this. Financial instrument. What else from our prediction? What else from our prediction? What else? What else? Have we not revised? Impairment loss? Okay. Okay. So I'll see impairment of assets. Impairment of assets. Risks. Okay, sawa. So then you can prepare on those three areas. Okay, first of all, prepare on those three areas. I think that what we will revise once we meet on Tuesday. Sasa, financial instrument impairment and also risks. Sasa, yes. So we stop at that point for today. Have a nice evening and also a nice weekend. We continue from there next week on Tuesday. See you then. This is one of the components of the financial statement which is prepared by companies, basically for the company to be able to show the sources of cash and basically the application of cash. So basically what that means is that once you're given a statement of cash flow prepared by a company, you should be able to see how the company generated cash and basically how that particular cash was spent. Now, a statement of cash flows basically should be prepared in accordance with this particular standard, International Accounting Standard number 7. And actually, this particular standard requires that when a statement of cash flow is being prepared, the various activities which are undertaken by the company, basically to be classified into three categories. I hope you can be able to recall those particular three categories. Number one, we have the operating activities. Number two, we have the investing activities. And number three, we have the financing activity. So anytime you are preparing a statement of cash flows as an accountant, what you need to do basically is to appreciate the fact that the activities of the company should be classified into three categories. Operating activities. So what do you mean by the operating activities? These are basically the revenue generating activities, which are basically undertaken by a business entity. For example, a business entity may be providing services. A business entity may be selling goods to its customers for that business to be able to generate what? Revenue, or to generate what? Income. So therefore, operating activities, these are the revenue generating activities, e.g. provision of services, e.g. the sales of what? Of goods. Now, on the other hand, when we talk about now the investing activities, these are those particular activities which include acquiring assets and also selling or basically disposing what? Asset. And maybe for those who are doing AFR, and this also include acquiring a subsidiary and also disposing what? A subsidiary. And then we have the financing activities. And basically, these are those particular activities which by the end of the day affect the size and the composition of the company's capital structure. So any activity undertaken by the company, it affects the capital structure of the company. That is the size and the composition is a financing activity. E.g., maybe the issue of shares, the issue of debentures, acquisition of bank loan, maybe the redemption of debentures which have been issued by the company, and so on. And then after classifying the activities into those three categories, in preparation of the statement of cash flows, we have to determine the net cash flows from each of these three activities, basically in that order. We determine the net cash flows of a company in that order. How do we determine this particular net cash flow? So to determine this, we take the cash inflow. Basically, when we talk about the cash inflow, this refers to any money which is flowing into the business. Like once the company sells an asset, the company receives money. Once the company issues shares or basically debentures, the company receives money. So the money which is received or money coming into the business, we basically refer to that as a cash inflow. The other rule is that when preparing the statement of cash flow, any amount which is a cash inflow, we record it in our statement of cash flow as a positive. As what? As a positive. So we take the cash inflows and then to this we less the cash what? the cash outflows. So the cash outflows, basically, this refers to any cash which is flowing out of the business. And the rule is that anytime you are preparing a statement of cash flow and you come across an amount which is a cash outflow, then you record it as well as a negative. So therefore, to determine these net cash flows, we take the cash inflows as positives, and then we less cash what? Cash outflows. So basically, we deduct the cash what? Cash outflows. That's why we are saying cash outflows. We record them as what? As negative. So by the end of the day, we will be able to get the net cash flow from operating, investing, and also what? Financing. So maybe the other thing you need to remember very fast is that when preparing the statement of cash flows, basically we have two methods which can be used to prepare a statement of cash flows, or in other terms, to present a statement of cash flows. We have the direct method, and also we have the indirect method. And actually, the difference between those two methods, that is the direct method and also the indirect method. Indirect method is basically how we determine the net cash flow from operating activities. That is the only difference. How we determine the net cash flow from operating activities. That is actually the difference between these two methods. So under the direct method, basically, we determine the net cash flow from operating activities using a direct approach. Basically, we go to the cash book prepared by the company. Number one, we take into account the cash received from debtors or customers, which is basically a cash inflow. Then to that, we less the cash paid to the suppliers or creditors. We also less the cash paid for operating expenses. We also less the tax paid and the interest which was paid. We will be able to get the net cash flows from the operating activities. That is now using the direct method. Now, under the indirect method, we compute the net cash flows from operating activities using using an indirect approach. And actually, what we do under the indirect method, we take the profit before interest and tax, and usually we adjust it with three items: the non-cash items, which were added or deducted in arriving at net profit. Number two, the changes in working capital, basically where we consider three items of working capital: receivable, inventory, and payables. And also we adjust that profit with any investing or financing activity item which was added or deducted in arriving at net profit. So basically, I think that is the first thing you need to remember as far as the statement of cash flows is concerned. And I think with that particular quick recap, I want us to go straight to a question. And there is a question which has already been shared in the class chat box, maybe for those who are joining us right now. So there is a question which has already been shared in the chat box. So if you can be able to see that question, please confirm that is the question you want us to do. Can you be able to see that question, those who are just joining? If you can be able to see that question, please confirm that is the question I want us to do. Can you see that question in the chat box? Can you see that question in the chat box? I want us to use the question from CPA foundation level. CPA foundation level. That is the question 4B of August 2024. Yes, so can someone reshare that question afresh? Evans, please reshare that question afresh. Reshare that question afresh. Reshare the question afresh. Yes, so I think it has already been reshared there. It has already been shared here. So let's go through it. We see what we are told and equally what the examiner was requiring here. So the question reads, part B, question 4B, it reads, the following are the financial statement of Precious Limited for the year which ended 31st of March 2023 and 31st of March 2024. So we are given Precious Limited statement of profit or loss, which is for the year which ended 31st of March 2024. We have the gross profit, operating expenses. We have other incomes which include interest income received, the gain on sale of investment, and then we have the loss on sale of plant. And then from there we have the interest paid, the interest expense which was paid, and then we have the net profit before tax. We have the income tax for that year, and then we have the net profit after tax. So then from there we have the statement of financial position. We are given statement of financial position basically for 2 years, 2023 and 2024. It is important for you to note that anytime you come across a question for cash flow, always the examiner will give you the statement of profit or loss for the current year, And then for the statement of financial position, that is basically the balance sheet, you'll be given the statement of financial position for the current year. For example, in a case, the current year is the year 2024, and for the previous year. So what you need to note is that the figures which are given here in the statement of financial position of the previous year, 2023, these are treated as the opening balances, whereas the figure we have here in the statement of financial position for 2024, those are closing balances. That's basically what you need to know. So we have the non-current asset, which include PPE, property, plant, and equipment, at cost and also accumulated depreciation. We have the investment, we have the current asset, which include inventory, account receivable, cash prepayment, and then we have the total current asset and the total asset. And then we have liabilities and capital, where we have ordinary share capital, revenue reserve. Revenue reserve, this is another name for the retained profit, or is basically another name for the retained what? Earnings. Then from there, we have the long-term liabilities, which include both. We have the current liabilities, which include account payable, accrued liabilities. And then we have tax payable, and then we have the current liabilities, total equity and liabilities. Then we have additional information, number 1, all the way to note number 7. So what then are we required to do here? We're required to prepare a statement of cash flows, which is for the year which ended 31st of March 2024, in accordance with the International Accounting Standard number 7, which governs the preparation of the statement of cash flows. Now, in this case, number 1, recall what we have said. There are two methods which are used in preparation of cash flow. We have direct method, we have indirect method. But if you check on this particular question, the examiner has not specified which method we need to use, whether we use the direct method or basically whether we use what? We use the indirect method. But anytime you come across a question for cash flow, you are given the income statement or the statement of profit or loss, statement of financial position. If the examiner is not specific on which method to be used, always use the indirect method. So the indirect method basically has so many free marks when it comes to computation of the cash flow from operating activities. So that is the first thing you need to do. The other thing, assuming these are questions you are doing in an examination setup, it is not advisable to start with the workings, because this where or what make majority of the students to fail in these particular questions. So how do you get free marks, or basically what you refer as the low-hanging fruits? So basically what you need to do is that once you come across a question for cash flow, number 1, never start with the workings. Just go straight to what the examiner is requiring you to prepare, because the 16 marks which are allocated here, they are allocated for preparing a statement of cash flow. So if you do all the workings, they are correct. By the end of the day, you fail to prepare the statement of cash flow, you will get 0. 31st of March 2024. 31st of March 2024. 31st of March 2024. Obviously, you must have the title. You must have the title of what you're preparing. And then from there, you need also to remember, in preparing this particular statement of cash flows, we have to determine net cash flow from 3 activities. So can you have those particular 3 subheadings? So basically, always, we start by determining the cash flows from operating activities. That's basically what we know. We start by determining the cash flows from operating activities. So here we need to have 2 columns, and I hope you can be able to see that if you go back to that question, all our figures are given. The figures in the income statement or the statement of profit or loss, the figures in the statement of financial position, they are given in thousands of shillings. So you need to have 2 columns here like that. So then from there, you leave some enough space here, because when computing the cash flow from operating activities, we have so many items which we record here. So leave enough space. And then from there, you have the other subheading for basically determining the cash flow from what? The cash flow from investing activities. And basically, remember, in this case, we have said investing activities are those activities which involve acquiring assets and also selling assets. So what we record here are the assets which were acquired, the assets which were purchased, and the assets which were sold. So we don't have so many items which we record here. Leave just enough space, not a big one. And then from there, we have the other subheading for determining the cash flow from the financing activities. And actually, all the items which we record here, we get them from equity and basically the non-current liability section of the statement of financial position. All the items which we record here, we get them from the balance sheet, specifically under equity and non-current what? Liabilities. And then down here, we come and we record something known as the cash and cash equivalent. This is cash and cash equivalent, a balance, a brought down, and also we record the cash and cash equivalent, a balance carried what? Balance carried down. Balance carried what? Balance carried down. That's the first thing you need to have anytime you come across this particular question for what? For cash flow. Anytime you come across this particular question for cash flow. And then having that now, I want we proceed and we look on how then do you get the low-hanging fruits. So there are the low-hanging fruits. Remember, we have said that these are the free marks. These are the marks basically you get without any working, without any what? Any working. So basically the first thing I advise my student to record is this: cash and cash equivalent at the start and also at the end of the year. So what do you mean by cash? Cash, basically, you can be able to recall, this is cash in hand, a cash at bank overdraft, and then cash equivalent. These are the short-term investments. The short-term what? Investment. So basically what we need to do is we go to our statement of financial position under the current assets. We check whether we have cash in hand, cash at bank, short-term investment, and then still we will go to where we have current liabilities. We check whether we have a bank overdraft. So can we do that? The first thing, we go to the statement of financial position, specifically under the current asset. So under the current asset, can you tell me which item of cash and cash equivalent do we have there? Which item of cash and cash equivalent do we have under the current assets? So tell me which item of cash and cash equivalent we have there. Which item of cash and cash equivalent do we have? Do we have under the current assets? Type it in the chat box.